Wall Street's biggest financial giants are making moves behind the scenes, and they all seem to have their eyes locked on one thing: your XRP. The world's largest asset managers, including BlackRock, are reportedly positioning themselves for something massive, and their latest prediction is sending shockwaves through the crypto world. A $10,000 valuation for XRP? It sounds unbelievable, but when you break down the facts, it starts to make sense. Think about it, Ripple's technology is already being used by banks and financial institutions worldwide, offering a real-world solution to a trillion-dollar problem: cross-border payments. Unlike most cryptocurrencies that rely on hype, XRP has actual utility, speed, and efficiency that traditional financial systems desperately need. And now, with institutional money flowing into digital assets, the question isn't whether XRP will rise, it's how high can it go. The same Wall Street firms that once dismissed crypto are now accumulating, strategizing, and preparing for what could be one of the biggest financial shifts in history. But here's what they don't want you to know: they always move first. Before retail investors even realize what's happening, major players secure their positions. The institutions that once mocked XRP are now silently stacking it, while everyday investors hesitate, distracted by FUD and market noise. And BlackRock, their $10,000 valuation isn't just a random number. It's backed by fundamental market forces that could send XRP skyrocketing. So what exactly is driving this prediction? And more importantly, what does it mean for you as an XRP holder? Stay with me as we break down the truth behind this massive institutional shift and why Wall Street is suddenly so obsessed with XRP. For years, institutional investors dismissed XRP as just another cryptocurrency, but things are changing fast. The same Wall Street firms that once ignored digital assets are now quietly accumulating them, and XRP is at the top of their list. But why the sudden interest? The answer lies in Ripple's growing dominance in the global financial system. Unlike other cryptocurrencies that struggle to find real-world use, XRP is already solving trillion-dollar problems. It has positioned itself as the go-to asset for cross-border transactions, a sector that traditional banking systems have failed to modernize efficiently. BlackRock and other institutional giants are not just speculating, they are strategically preparing for the next financial revolution. Their interest in XRP is driven by its ability to settle international transactions in seconds, with near no fees, making it the perfect solution for banks, payment providers, and even central banks exploring digital currencies. As regulations become clearer and mainstream adoption increases, these institutions are getting in early, ensuring they don't miss out on what could be one of the most valuable assets in the financial ecosystem. Another major reason Wall Street is suddenly paying attention is liquidity. XRP was designed to facilitate high-volume transactions, making it an attractive option for financial institutions looking for a digital asset that can move money seamlessly across borders. The ability to handle massive liquidity pools is exactly what hedge funds, banks, and asset managers look for when investing in an asset at scale. Unlike Bitcoin, which has high transaction costs and slow confirmation times, XRP's technology is built for speed, efficiency, and mass adoption. This isn't just speculation. There's growing evidence that major financial players are quietly buying XRP behind the scenes. When institutional investors start showing interest, it's usually for a reason. They don't chase hype. They make calculated decisions based on long-term potential and infrastructure. The same institutions that once dismissed XRP are now preparing for what could be the biggest shift in the financial landscape. But the biggest question remains, what exactly does BlackRock see that makes them believe XRP could reach $10,000? Let's dive into their prediction and the market factors that could make it a reality. BlackRock's $10,000 XRP prediction might sound extreme, but when you break down the logic behind it, the number starts to make sense. Institutional investors don't throw out random price targets. They rely on data, market trends, and real-world utility to make their decisions. So what exactly is fueling this bold valuation? It all comes down to XRP's unique role in global liquidity, institutional adoption, and market positioning. First, let's talk about cross-border payments, a trillion-dollar industry that is still stuck using outdated systems like SWIFT. Every day, banks, financial institutions, and businesses move massive amounts of money across borders, and they're losing billions in fees and slow transaction times. XRP is solving this problem, offering near-instant transactions at a fraction of the cost. Imagine a future where banks around the world rely on XRP to settle payments in real time. the demand for XRP would skyrocket as financial institutions compete to hold enough liquidity, pushing its value to levels we haven't seen before. Next, we have liquidity hub expansion. Ripple is working with major financial institutions to integrate XRP into their operations, making it easier for businesses and banks to use it for settlements and transactions. Liquidity is everything in finance. The more institutions use XRP, the higher its demand. If XRP becomes the standard bridge currency for global payments, the need for trillions of dollars in liquidity will be met by XRP holdings. And when demand outpaces supply, price surges follow. Then there's the supply factor. Unlike Bitcoin, where new coins are constantly mined, XRP has a fixed supply of 100 billion tokens, with a significant portion locked away or lost forever. Scarcity drives value. If major financial institutions start holding XRP in bulk to facilitate global payments, the available supply for retail investors will shrink dramatically. What happens when demand increases while supply remains limited? Prices explode. And here's where things get interesting. XRP's potential market capitalization. If XRP becomes the backbone of global liquidity, handling cross-border transactions, CBDCs, and institutional settlements, we're looking at trillions of dollars in potential market value. When Bitcoin first hit $1,000, many doubted it could ever reach $10,000. Now, BlackRock is betting that XRP could follow a similar path, reaching levels no one thought possible. But price predictions mean nothing without regulatory clarity. What happens when the SEC lawsuit is resolved? Will institutions go all in? The answer to that could determine whether XRP's valuation reaches BlackRock's bold $10,000 target or beyond. Let's break down how regulation could be the final catalyst for XRP's rise. For years, regulatory uncertainty has been the biggest roadblock holding XRP back. The SEC lawsuit against Ripple created fear, uncertainty, and doubt, keeping many institutional investors on the sidelines. But now, things are shifting. With recent legal victories and growing clarity around digital assets, the narrative is changing. Once regulation is no longer a question mark, institutions will have the green light to go all in. And when that happens, XRP's price could move faster than anyone expects. The biggest concern for institutions has always been compliance. Banks, hedge funds, and asset managers can't just jump into crypto without regulatory approval. They need clear rules, proper licensing, and government backing. That's exactly why many of them have been hesitant to accumulate XRP in the past. They were waiting for legal clarity. But now, with Ripple winning key court battles and proving that XRP is not a security, institutional investors are starting to take notice. If the SEC officially confirms that XRP is fully compliant with US regulations, it opens the floodgates for big money to enter the market. This means that asset managers like BlackRock, Vanguard, and Fidelity can add XRP to their portfolios without legal risks.